afternoon, everyone, and welcome to this afternoon's sessions. My name is Laurie Forbes, and I work for the Department of Agriculture out of the Paw location. So, yeah, we have agriculture up there, just let you know. All right, so before we get started, can you please turn your phones to silent? And if you do take a call, if you could just go right out into the hallway to take that call, not just up in the top area, that's right there. We have CCA and CEU credits. Use a QR code or a sign-in sheet at the table at the top if you are collecting those credits as well. And we'll get started. So this afternoon we have Britney Toovey, and Britney is a senior manager with MNP's specialty tax team based out of the Brandon office. Britney earned her Bachelor of Business Administration from Brandon University in 2012. She's a chartered professional accountant and completed CPA Canada's in-depth tax course in 2017, further solidifying her expertise in the field. And here you are, Britney. Welcome.
Thank you very much. Hello, everyone. It is so nice to be here today. We are here to talk about tax planning for your transition and sales. So, first thing we usually think about when we hear tax planning, usually tax minimization. But we urge you that we want to look at it from tax minimization and meeting your goals. We don't want you in a complex situation when we can meet your needs in other ways. A lot of times too, there are thoughts that, well, we have to go one way or the other. Either we have to gift the whole farm, or we need to sell it. And really, there is a middle ground. We can meet your needs and your future needs for your children. Just like every family is different, every farm is different, and every tax plan is different. With tax planning, we're concerned about what's at stake. So not only cash in your pocket, but also knowing what tax you're going to have in the future should provide you with security. When you have security like that, you can make decisions about donation planning back in your community, maybe capital planning to purchase more land someday. And we always like to talk about all your options available because your best laid plans can change. Maybe you sent a child off to university and thought you'd have to sell the farm. Well, turns out they met someone and they're bringing home someone who maybe would like to farm with you. Also, taxation changes. So, we can have taxation changes that are positive, like Bill C-208. And then we can have taxation changes, they increase ambiguity, uncertainty. So, all of these things will come into play when we're looking at your tax planning. Today we're going to discuss transitions to children, sales to third parties, and a few different subjects within both of those areas. So starting off with transitions to children, we always like to begin at an intergenerational gift. And when we're looking at those intergenerational gifts, we need to have farm property. And that is going to be our depreciable property, our farmland, family farm partnership interest, and family farm corporation shares. We must be a qualifying person when we are gifting that property. They need to be resident in Canada. So no children off in England going to university. And all of that property must be used principally in farming by that qualifying person. These gifts will take place at their cost base and they will not trigger any tax. Once we have a good feel for who a qualified person is, then we're going to look at land, because land is typically folks' largest asset in their family, as well as land drives many of the tax provisions around can we gift, can we use our capital gains exemption. And when we're looking at land, it's really the history that matters. It's the specific details that will matter. So we have a list of questions up here, but really important ones is when was it purchased? When did it come into your family? How did it change hands? What year? Who owned it prior to you? In what year did you take ownership? Who inside and outside the family has actively farmed the land? And what are the total years farmed by family members compared to years rented? And that one, we're going to put a big star next to that one. And did those farming the land have any non-farming income? And if so, how much was it? All of these little details matter and will impact the analysis. We want to prioritize getting that land history completed while we still have our previous generation here. So it's a lot easier to go have a visit with Grandpa than to have to someday go to the land titles office and ask around, and it's a lot more involved. So we urge you to deal with that now. So when we're discussing transitions and sales, we also want to discuss a qualifying person. So a qualifying person is going to be yourself, your current spouse. We're going to go up, that's parents, grandparents, great-grandparents, and as well down, children, grandchildren, and great-grandchildren. Notice I'm not saying siblings, aunts, uncles, cousins. No matter how much you love them, unfortunately, they are not a qualifying person. So we have our little family here. We have Grandma and Grandpa who had 2 daughters, and those 2 daughters got married, had families of their own. We have our folks with their little dog, and our other side even has a new baby. So who would a qualifying person be to our lady circled in red? That is going to be her husband, her child. Another qualifying person would be her parents, and then all the way up to her grandparents. Then we have the mom, and who would be a qualifying person to mom, and that's going to be her spouse, all of her children, so all those folks there, and then also her own parents, so grandma and grandpa. And then finally, what about grandma? Who would be a qualified person to grandma? Everybody but the dog. So you can see we have that straight line through that family tree, not zigzagging back and forth between those two daughters is the point here. So now that we know who our qualifying people are, what are we trying to qualify for? So that is going to be our capital gains exemption and our transition to children. So with that capital gains exemption, that's our $1 million-ish lifetime exemption used on gains arising from sale of farm property, including qualifying land. That's going to be used in your year of death if you still haven't finished it up. It could be used to reduce future capital gains. It's going to work on a declining balance, but you can't transfer it if you haven't used it all up. Right now, based on the potential $1.25 million capital gains exemption, it's about $400,000 of tax savings in Manitoba. So it's really, really serious we get this right. We always want to be aware of alternative minimum tax, or AMT, when we're chatting about capital gains exemption and OAS clawback. Because once we start using our exemption, we can fall into those rules, and we don't really want any surprises about, losing your OAS for that year. We also have our transition to children, where you can gift qualifying property, including land, to a child without triggering any personal tax. Often that recipient child will have access to their own capital gains exemption, and we don't need to use the parent's exemption, allowing them to preserve it for other property, or possibly parents may not have any left. And that gifting can be done on lifetime or during death. So our next step then is to look at what it takes for our land and other property to be considered qualifying property. So looking through our land, when we want to transition that land to our children, that land must be farmed principally, so more than 50% is our key number there, by one of those qualifying persons as a proprietorship, or it can be farmed by the partnership or corporation in that qualifying person was actively involved. So when we're talking 50%, we're looking at the number of years actively farmed versus the numbers of years rented. And we only need 1 extra farming year. Interestingly enough, those farming years actually can be counted when you have rented the land from somebody else. So back when you were 20, you rented that piece of land from the neighbor, you eventually bought from the neighbor. Any of those years you rented it and were farming it, they get to be picked up as your farming years. We have to apply that test on a quarter by quarter basis, and excitingly enough, unlike those capital gains exemption rules, land is not always qualified for transition. So we have to be very careful watching our years back and forth between the farm and the rented. Our planning is key. Once we understand that land history on a per quarter basis, we can monitor it and determine when it would no longer be qualified for gifting. And there are actions we can take to deal with that once we know. You do have the option to consider gifting your land before death when it is still qualified. You also have the option with your planning to hold on to your capital gains exemption and cover any remaining gain that is listed on your property that might no longer qualify. We have situations where families would like to gift land to their children during their lifetime, but you cannot use your capital gains exemption on that unless you are issuing an actual promissory note. And what we would see is that will would have to have that promissory note forgiven upon passing. And where folks might get concerned is that you think, oh, well, it'll be fine. You know, my children, they'll take care of me, right? But we have to remember the parents could come in and ask for that money later. It is not a gift. It is concerning sometimes where we have to make sure we don't have any issues with what everyone's expectations are. So looking at our transition of shares, when we have shares that we are interested in gifting, they actually need to be considered shares of a family farm corporation at the time of the sale or the transfer. So these rules we're going to walk through a little bit have the same terminology for sale as well as transfer. We have two tests. So we have our 50% test and our 90% test. Looking at our 50% test, we are making sure that a farming asset is farmed more than 50% by the corporation that it's in the qualifying person was actively involved on a regular and continuous basis. So if we're talking about land, we are going to go back to those personal land rules where we're comparing farmed years versus rented years. If we're looking at equipment, machinery, we're going to have to consider any custom work that's being done, or if it's being used by a non-qualifying person. So, you know, you're renting to your nephew, anything like that. Then we have our 90% test. So to qualify as a family farm corporation, at least 90% of the fair market value of the whole corporation must be considered a farming asset. So first point would be any of those capital assets that we made sure met that 50% test, which a lot of value would be in your land. Then we have inventory, deferred grain tickets, prepaids, patronage. Agri-invest is a tricky one. So it is deemed not to be an asset for purposes of this calculation. So you can take that off your list if you're looking at your own balance sheet. We are very concerned about the non-farming assets. So excess cash. If you have cash that you are using annually and you're working through that balance every single year, that would be considered a farming asset. But if you are growing that cash balance, it's sitting in GICs, maybe even an extra savings account, CRA is going to consider that a non-farming asset. Anything like an investment in a marketable security, non-farming real estate, amounts owing to individuals or non-farming companies. A great example of that is you loan money to your child, right? Or your child's corp. Well, then that's not going to be a farming asset. And then any other capital assets that do not meet that 50% test. So it's happened, you know, we don't qualify. What do we do now? Well, it actually does not have any bearing on your annual corporate tax liability. So that'll be separate. If in the case that the family is not having their corporation be a family farm corporation, at the time those shares would be gifted to the children, they are going to have to transfer at fair market value. So with math, like a 10 million farm, that's going to be over $3 million in taxes. It's significant. It's a big deal to have that fall off the table for families. There is no ability to qualify after the fact. So it's something that's really important that we continue to monitor all the time on here. How do we get back on side? Well, there's multiple ways we can deal with that. Quickest, buy more farming assets. Maybe you upgrade that piece of equipment, or maybe you pay down the debt on the land. Anything that, can get that cash balance lower. Maybe you finally transfer out balances to the shareholders. Clean up your shareholder loan. You could do a one-time transfer of non-farming assets to a holding company. Maybe you have a custom trucking operation rolled in there, or maybe seed. You get that out. And we also have scenarios where the cash buildup is just too high year after year, and that may be the time to consider doing a family trust situation. Some of this planning is really great to consider as tax insurance. Just like you would monitor any other asset, same thing here. We want to look at this ourselves, talk to our advisors, and be aware of where we are sitting. The gift provisions are so wonderful because they do not have an upper limit on how much value can go to the next generation. Compared to the capital gains exemption, it's that $1 million-ish per person, whereas when we're talking gifts, it could be, 20 million, right? You have no upper limit on that. As we said before, because each family is different, every farm is different, everyone's planning considerations here will change. It's going to depend on your future plans. Are your children involved? How far offside are we talking? Is it a $20,000 problem? Is it an $800,000 problem? All of that will matter. One option we like to discuss is always our corporate freeze. And that is going to be where we take your corporation, we value it at a specific date, and the current common shareholders have those shares locked up into fixed value preference shares. So then, because all that value is locked in for the parents, you could reissue common shares to your children, maybe you and your children, and those can be at a nominal amount. So everyone's doing $50 each to get back into the company. Now we have this set of preference shares, and so what do we do with them? We can redeem them over time and pay dividend tax rates on that. You could gift them during your lifetime to your children. Maybe you dispose of them upon death. That could be part of your plan through a gift or capital gains exemption. And if we set everything up right, you could do possibly a Bill C-208. So prior to Bill C-208, parents could not use their capital gains exemption on a sale of shares in a farming company to their children, unless their children used personal funds to buy out their parents. So a lot of times, people were going the freeze route or the gift route because that wasn't available. Whereas if you sold to your neighbor down the way, you could have that preferential tax treatment. So in 2021, Bill C-208 was introduced as a private member's bill by Larry Maguire, and it allowed these transitions where a parent can sell shares to a new company created by their children, and their children can use corporate dollars to pay out their parents over time, and the parents get to use their capital gains exemption. So to do a Bill C-208, the shares must be qualified small business corporation shares or qualified farm fishing property. And so to meet those rules, we're going to go back to that 50% test, 90% test that we just previously chatted about. The purchaser corporation is going to have to be owned by the children, and that purchaser corporation is going to have to hold the shares for a set period of time. The new rules that have been introduced are that they are immediate transitions and gradual transitions. So those immediate, are 1 to 3 years. So that's your kids that are ready to go. Like, we are ready to take over. Where our gradual will be 5 to 10 years. And so some of that might be based on age, it might be based on, just where your family is at. So you would fit into one of those two areas, and then each of those have different rules about the 5 categories. So transfer of control of business, transfer of equity, transfer of management, how long the purchaser has to retain control of the business, and how long the purchaser would have to work in the business. Love this diagram here. So just a quick illustration of where we are at the end. Once our C-208 has been completed, we have our family farm, It is now owned by a new company, which is above that. We have our son and daughter, and then the new company has a loan over to mom and dad. So who is our ideal candidate? That will be the family farm controlled by mom and dad. Mom and dad are ready to transition, and the next generation is ready or just about ready. And mom and dad will have a significant amount of their capital gains exemption available. So earlier we talked about cases of ambiguity with tax planning, and one example would be right here. Because if you've made your tax plan and you ruled out a C208 plan because you didn't think you had quite enough exemption, well, now suddenly, if the capital gains exemption rate increases, you have more exemption, so does your spouse. And maybe the cost-benefit analysis of doing something like a C208 plan changes for you. So, sales to third parties. There will be families who are in a sole proprietorship where it makes the most sense to wind down the operations. Your final farming year will have no inputs, so your income is likely to be triggered on that final sale of inventory and equipment. Luckily, there is usually some flexibility to be able to time your sales of inventory, so do a little in 24, do a little in 25, and help lessen that tax burden. With the rise in the value that folks can get on used equipment, you may see that the sale of equipment could trigger recapture, which gets taxed as income. And so you want to time that carefully with any sales of inventory. There are situations where the amount of inventory and equipment to sell, it does make sense to transition into a corporation and then sell that inventory out and your equipment out over time, because you would pay 9% tax rate up to $500,000 on that income. And then anything you take out would be paid at your personal tax rates. So it gives you some flexibility and control over how much you want to take out each year. In situations where you're still in a partnership, we're going to operate quite similar to the sole proprietorship. However, you can split that income between you and your spouse. So you do have a little bit better usage of any tax rates. There are families who will decide that they still would like to incorporate their farm partnership. And so we can do that and generate tax-paid shareholder loan by using the lifetime capital gains exemption. Similar, you would have a tax rate on anything then you sell out of the corporation, and personal tax rate would apply. So sales of land. We're going to revisit again that qualifying person discussion, so we start there every time. Who would be a qualified person? Yourself, your spouse, parents, and up, and then children, grandchildren, great-grandchildren. What are we qualifying for? We're going to try to qualify for the capital gains exemption or the transition to children. So with the capital gains exemption, like we chatted about, that's about our 1 million, hopefully 1.25 million amount there. So qualified farm property is actually a different set of rules depending on if you are gifting versus if you are selling and trying to use your capital gains exemption. And we have a special date in there, 1987. So if your land was purchased after 1987, it must be used principally, so that's our 50%, at least 2 years for farming by either the qualifying person or a partnership or corporation that qualifying person was involved in. If it was acquired pre-1987, it can also qualify if it was farmed by a qualifying person in the year you're trying to sell it, or any prior 5 years. You could use that. Once that land is qualified for capital gains exemption, it will always be qualified. So it's locked in for that qualifying person, and then 3 generations below them. For sales of shares of farm corporations, when we are doing that, we again have to make sure we fall into that family farm corporation definition. That's our 50% test and our 90% test. When we are looking at the analysis, and you maybe you're doing some math in your head, with that, even 1/4 of land could be enough to take you out of that 90% test. Because if that one piece has been rented way more than farmed, suddenly it doesn't qualify, and that piece of land has such a high fair market value that on an overall picture of the farm, it could take you out of that 90% test. We've also seen it with cash. We have 2, maybe 3 years of really high grain prices, and now suddenly, that's it. We have a very large cash balance sitting there. When you're selling your farming company to a third party, you may need to clean up some of the assets. And maybe that's because it doesn't qualify. Or maybe that's because the buyer just doesn't really want all of the assets in there. So sometimes it can be for land. We can swap that in and out with other lands you might have outside the company. Maybe you're selling out personal assets and you're going to pay tax when you sell those out. Maybe you're cashing out investments, right? They don't want your GICs in there. When you are selling shares, you do have a reserve available if you receive that payment over time. Although we got to use that one with caution and speak to your advisor about using that, but it's important to know it's available. We have alternative minimum tax, and then OAS clawback, any pharmacare changes, anything that is an income-based program could be impacted by that 1 year that you claim that large capital gain. With the suspension of Parliament on January 6th, we have suddenly entered an uncertain tax environment. It feels like again, and so we have 2 tax measures of concern, which is our capital gains inclusion rate and our lifetime capital gains exemption. So now there is some uncertainty if any of those 2 tax measures will be enacted prior to the filing deadline, and if they aren't, then how will CRA treat them? And our advice to everyone right now is to sit tight and assess. Speak with your advisors. Only they know what will be best for you in your situation. So, where do you start if you're ready to do this today? Take the time to document your land's history. Consider your goals for your farm and your personal life. Please review your wills. Monitor your cash and any investment assets inside of your corporation. Today, we took a pretty quick, high-level view of many tax strategies available to work with your tax planning on transition or sale. Every family is unique. You need a careful review of the rules to make sure your conclusion is released. Tax-driven decisions should support your goals, and please meet with your advisor and seek advice. It is always going to be worth your time to ensure your plan is the right fit. So ultimately, we would like to keep more of what you've worked so hard to build. Thank you very much.
That was great. Thank you, Brittany. That was really great. Thank you very much.